Uh, Hello. Yeah. Good evening, everyone. Thanks for joining for this BFSI Bharat FinTech event. And I'm Hiren Dharamshi. I'll be your moderator, and we'll discuss few things today, and we'll share the bits to the audience and everyone around. So I'll just suggest, like, if you can introduce yourself in a minute or so.
Hi, I am Nisarg. I'm a senior vice president at 361 Asset Management. I largely take care of about fintech distribution and partnership. Largely interacts with investors to help innovate what their needs are out there right now.
My name is Deepak R. Khemani, a financial planner by profession. Having been in the markets for the day I became 18, it's now like almost 42 years. Started out as a retail investor, became an IFA, then gave it up, became a stock market observer, a coach trainer, and now a best-selling author.
Hi, good evening. I'm Naval Kagalwala. I'm the COO and product head at Shriram Wealth. So this is part of the Shriram group of companies, but the wealth is part of the capital markets, which is one of the newest ventures started by the group sometime last year in June.
Hi, good evening, everyone. I'm Nehal Mota. I'm the co-founder of Finovate. So we are India's first and the only financial fitness platform. So we start with financial planning, which leads into wealth management, and we basically help Indian families become financially fit.
Thank you, everyone. And as we all know, that today's topic is, what we feel now going forward. So the new concept, which is called DIY, which is growing a lot of momentum. And of course, the old buddy SIP is definitely there. And the technology is democratizing a lot of things. So we'll start with you, Nisar. And what do you feel like, with today the access to the systems are very pretty easy. You can up your account, open your account in next 30 seconds, 1 minute. But what do you feel that investing is, investors are overestimating how, the profits will be made, or how the portfolio needs to be created? Are DIY helping them, or without guidance, do you think they are able to, or they will be able to manage something in future or create wealth?
I would say to an extent it's helping. Like you said, over the last decade, the access has become really, really easier for them. You can open an account, compare multiple funds. With the help of AI now, you can go even deeper into that these days, right? But it still does not help you to correct on many other aspects, right? You need to understand while investing, what's your risk management? What's your eventual goal while you are investing into an asset class? What's the taxation looks like, right? Does it gives you liquidity at a point where you need from that? Like all of these aspects require a lot amount of learning and a lot amount of guidance as well, right? DIYs are good for you to execute faster, is to be aware, to get reports if you want at a time. But I would still say for a very mass investment, guidance is still must, it's required. And guided platforms are far better than DIY platforms to an extent.
Absolutely. So definitely, we'll take Naval sir's help here. That what is your thought process? Like, because of these platforms, definitely people are able to start there. But what do you feel that the real wealth building? Where do you see DIY versus guidance?
Okay, so I'll endorse what Nisarg has said. I look at technology as a facilitator, right? It definitely helps somebody in terms of accessing their account, doing transactions, tracking their portfolio on a regular basis. So it is a means of making it very, very easy and convenient for people compared to the traditional paper-based processes, right? I mean, today you can execute transactions very, very quickly. You don't need to go about from one place to another, standing in queues to submit your form. So that's the facilitator. But does the person who's doing the transactions as a DIY fully aware of what he or she is doing, right? I mean, today we have thousands of mutual fund schemes, right? We have almost 38 to 40 categories and subcategories of funds. You have PMSs, AIFs, now SIFs, then you have bonds, you have ETFs, you have REITs, InvITs. I mean, you have a plethora of products available across different asset classes. what is right, what is wrong. I mean, even today, most of the investors invest in schemes just looking at your historical returns of mutual fund schemes. Is that really the right way to look at it? And that is what we've seen, right? I mean, typically you'll end up investing into some sectoral product or a thematic product because it has done well historically. But that doesn't mean that it will do well in the future. So that's the problem and that's the challenge. Today, most of the investors are still not that financial literate or sound to take most of the decisions. So yes, from an execution perspective, it does add to the convenience, but there is a bit of guidance which is also required.
Thanks. I'll just extend this to Nehal also. That what do you feel like? Does DIY really work, or do you think it's good for the beginners and then the handholding will be making a lot of sense going forward?
Yeah, so I was just going to come to that for someone who's just beginning investing, maybe SIP is the most simplest and easiest way to begin and maybe accumulate a certain corpus. But when the portfolio grows larger, say in a couple of crores, that's where the complexity starts coming in. And for what we've seen the markets in the last 18 months, the volatility, not everyone can really differentiate between risk and volatility. Okay, people confuse volatility with risk and then they end up making decisions which are not in sync with their long-term life goals. So maybe DIY investing works in the initial phase of an investor's journey, but as and when the portfolio size and the complexity grows and a lot of money is on stake, that's where you need to understand the downside risk and you need to differentiate volatility with risk. And like I said, right, emotions play a very big role in investing. It's not just the simple numbers or mathematics. And probably with the help of technology, AI, you can get a lot of data. Maybe you will learn to process the data, but how would you control your emotions? Okay, and that's where I feel that hybrid, what he spoke about, that hybrid where tech is an enabler, but there is also guidance to not make mistakes, which a lot of investors would make when volatile times. So in a good bull run, everybody makes money and they think that they're very smart investors. But when the times are challenging, and right now the world we are in, it's a VUCA world. And every few years you will have events coming up which would really make you think whether what you're investing, is it correct, not correct. And like he said, there's so many choices. What worked in the last 5 years may not necessarily work in the next 5 years. So the portfolios will need to be reinvented depending on what is future. And that's where you require guidance. Even experts get it wrong at times. How can you understand common people with all what they have to do in life, getting it right with investments and with large portfolios? It's kind of difficult.
Absolutely, absolutely. We'll take Deepak sir. Yeah, sure. You can.
If I can just add to what Nehal said. See, I mean, a larger investor, yes, definitely. But the beginner, I mean, the person who's starting today is going to become a bigger investor over the years, right? As he grows in career, collects more money. The initial experience that he or she goes through will set the tone for what he or she does in the future, right? So if, let's say, the initial experience of a beginner is incorrect or wrong today, right? All likelihood that they will not pursue that investment as they go ahead because that stays in their mind and memory. So even for a beginner, however small that investment should be or would be, still will require some bit of guidance, right? Even if it is an SIP, I mean, large cap में करना है, flexi cap में करना है, multi cap में करना है, mid cap में करना है, small cap में करना है, hybrid में करना है, किस में करना है, right? I mean that 5,000 or 10,000 rupees is big for that individual, right? And therefore he has to get it right. Where and how, of course, if he knows, then great, but otherwise guidance is required.
Deepak ji, I would ask you in a very different perspective because you have done everything from being an IFA to the coach, and you must have coached not only mutual fund distributor, you must have done investor sessions. So from a financial lens or for the literacy lens, how do you see the different breeds of investors and their behavior? From the handhold investors in say 90s or 2000 or 2010 versus 2025 and onwards, the DIY, the Gen Z. So how do you see this shift and what's your take on that?
That's a really long question. Permit me 2 or 3 minutes to...
No, you can please.
So when it was the 90s and we used to go and tell people invest in mutual funds. कितना interest देता है? पर interest नहीं देता है. You don't get interest in a mutual fund. You get growth, the value appreciates, or you will probably get a dividend when it has some distributable value in the NAV. You will not get an interest. From those days in the early 90s to today in 2026, as has been discussed, press a button, do your KYC in 1 minute or 2 minutes and start investing. I wouldn't say investing, but start trading. Invariably, most Gen Zs want quick results. And if I want quick results and I'm logging in and thinking which scheme I should invest in, I'm searching for 2 or 3 sites or AI chat, asking them which is the best performing scheme this year. Let me throw this question open. Anyone knows which is the best performing scheme this year? It is SBI PSU fund.
Okay.
Okay? If there are 500 people in this whole event place, 499 of them have not heard of SBI PSU fund. Okay? So there will be funds which will work during cycles. Now the last cycle has been that people have gone out of private banks and gone into PSU banks, and a lot of PSU sectors are running. So today that is the best performing fund. 6 years back in 2020, the best performing fund was PGIM mid cap fund. Today it is not even in the top 50. That's how DIY investing will take you aura. It will not get you to, as she said, your financial goals. Because you are chasing returns, you are chasing profits. You aren't looking at the scheme that is suitable to your risk return profile, whether it matches everything you want to do, or you want to buy a scheme which is the best performing scheme as of today. So this is a mistake everybody makes. This is a mistake we also made when we started. If you would indulge me for another 2 minutes, when 9/11 happened, Twin Towers crashed. We found that kya hoga India ka? People, planes are falling into buildings. Let us exit the stock market. Now, 25 years ago, I sold one of my bluest of blue chips just to get some money back into the bank. Don't know what will happen. I'm sitting at a 10x loss if I wouldn't have sold it at that time. But that is a journey all of us have to go through. You either pay fees to the market or you pay fees to an advisor.
Absolutely. So if I sum up this first part of the discussion, I feel that the model has to be phygital, that there is a digital enabler and there is a human being who's solving the problems.
I'll just, sorry to break you up over there. Everybody talked about robo investing, and there was a good, explanation to the robo word which was coined. It said, research online, buy offline. Research online, buy offline. As you said, phygital.
Absolutely. So why I could gather these ideas is that's basically that digital is definitely enabler, as Naval said, that use that as an enabler, but there needs to be an advisor as your wealth grows. So again, a little in adding to this query, lot of because of the influencing world, investment has become entertainment, and that's where this DIY concept came in, not only because of technology, but because of lot of influencers putting in this. So there is a two diverse thing now, whether we have to look at democratizing investment or whether we are here to build wealth. Nisarg, what do you think? Which is the right path? Democratizing investing or building wealth? Where do you see the right path here?
See, in my opinion, both probably go in sync. So until unless there is democratization which is happening, the financial inclusion of a larger audience will not happen, right? Like post-COVID, it was an inflection point where everyone had a lot of time. They watched a lot of an influencer, moved into doing investing or trading or doing the same mistakes, right? That got them introduced to the market, right? And that expanded the base. Now that's the first part. That's always required. Democratization is part to move towards second. So when you have made those big mistakes, you became a learned person. And then you move to the second part and say, okay, now I've done my mistakes. Let me take it seriously and go beyond. Take in help from an advisor and move from that point.
Great, that is good. But what we have seen here is, people tend to, as you said, first stage में loss किया, तो they come out and say that ये product मेरे लिए सही नहीं है, and they never come back. So the problem here is a very tricky one, that people have tried a lot of things, and then we have lots of data which shows that things are not working for larger part of people, and building wealth is definitely hand holding. Rather than IQ, I feel EQ makes more sense. What's your take on?
Yeah, so I will
basically-
just want to say you brought a very important point that, is democratization important or is building wealth? I see a lot of 20-year-old in my office who got introduced because of whole democratization, okay? And unfortunately, they got into derivatives without even understanding what derivatives is or what the risk, getting lured into quick money. And how did this happen? This happened because of a lot of finfluencing which was happening. So if influencers were I can say planted in social media to drive traffic to certain apps and, getting them, pushing them to download those apps, and derivatives was glorified as something which can make them quick money. And
Like
unfortunately,
double your money in 21 days.
exactly. And unfortunately, I have seen hundreds of young kids who've lost the future 5 and 10 years of their income in this leverage of derivatives. So imagine that, forget the capital, that small capital they would have lost, they would have leveraged, and they've ruined the coming 5-10 years of their income into this. Okay, so while democratization is important, but it should also be backed with very strong financial literacy. And like he rightly said, that initially when people come and if they have bad experience, then they go back and they don't want to come back, right? So why not begin when you are a student, you start with ABCD, and then you graduate up, and then you get into things, complex subjects or complex. Same way, I think if financial literacy can be mixed with the whole democratization in a way that people know, okay, now I am just completed my ABC, okay? So the pyramid, that you begin with understanding the basic needs, start with, say, small mutual fund investments, build a corpus, then you get into a little sophisticated investment products, and even further. So if regulator comes up with something where your net worth and your asset allocation, if that is known, or if they ask certain questions around it, and then they allow you certain investments and disallow you certain investments, then democratization together with financial literacy will really solve a lot of issues which we are seeing right now. So I think link your products or what you can dabble into with your net worth. I think it can solve a lot of pain points what we are seeing today, and actually save lakhs and crores of the retail investors.
Navalji, again, since you said you 1.5 year into this entire new ecosystem, here also your take on democratization versus handholding versus DIY. I mean, these things, we are hearing a lot of democratization in investment is important, but the pitfalls as we see today, like as SEBI says, 90% of the accounts are making loss. So thanks to democratization, or what's your take here? Like, or
See, I mean,
are we missing that piece anywhere?
Yeah, so democratization is important, right? I mean, you have to have the larger cross-section of your people saving and investing, right? That's when they will be able to meet their goals over a period of time, right? If they continue to just keeping money in cash, or traditionally, let's say they've kept it in gold and plain simple vanilla fixed deposits, there's no way that they're going to beat inflation over a period of time, right? So then it's not going to work out for them if they have to build the wealth and reach the financial goals. So one, yes, we have to go down to the lowest common person and get them to save and invest, right? And which is why some of the steps that SEBI has taken in terms of micro SIPs and everything is helpful and critical towards that. But the issue is that people don't stop over there, right? Because they are looking at investing as a quick, easy way to make money, right? They hear about other people saying that, अरे हाँ, उसने derivatives में डाला, ये stock में डाला, उसका 10 दिन में 20% बन गया, right? मैं भी कर सकता हूँ. Why not, right? And that's where the FOMO element or whatever he or she is doing, I try to replicate that, but without understanding what I'm really doing or understanding. Because he has done it, I will also do it, and I can do it, right? But that person is not going to tell you that if he's invested in 10 stocks, he's made losses in 9, he'll only talk about the profit that he's made in 1, right? And that's what you will end up doing. So that's where the biggest challenge is, and that's where even SEBI And rightly so, after the study that they did, and we all know about the study on the derivatives that SEBI did, realize, sorry, realizing that more than 90% of the people are actually making losses, have taken steps to curb that. So yes, it is important because today the contribution of household savings to products like mutual funds and equity is still very small compared to globally. So yes, it has to go up, it has to increase, but in a proper planned manner is how it should be.
Deepak ji, again, now looking this as Nehal said, financial literacy comes into the play here. So I generally say, yellow signal is the most important signal in rather than the green and the red. So here, democratizing versus financial literacy, not versus, but financial literacy. How do you see the role of financial literacy should be placed by the fintech platforms so that this DIY, investors have some yellow signals rather than getting into, and what we have seen, like बाद में बोलते हैं मज़ा नहीं आया यार, investment ऐसे ही मज़ा करने के लिए नहीं है, it's a long term exercise. So what lens do you want to put here?
So it's very good that you asked this question about yellow, red and green. I'll take you back 2.5 or 3 years. A very prominent mutual fund ran a full page ad in all the newspapers in India saying currently the market is close to red. Be careful. In the next 2 years, market multiplied by 2x. The CEO had to actually leave and he went to another mutual
Absolutely.
fund. So it is good to have some sort of an indicator which tell you that market is either overheated or it is in the green or it is in yellow. Beyond a point, it doesn't make any sense. So if I'm an SIP investor and my goal is 15 years away, I should be praying for that indicator to be yellow and red for the first 10 years. I don't want the market to move for the first 10 years so that I can buy more units when the market is down. So when that indicator goes up and down, and if I keep changing my investment basis on what that indicator is showing, this is not financial literacy. Financial literacy starts in school. How many schools, whether it is SSC, ICSE or CBSE or even international IGCSE, have a subject called personal finance? None. Even people coming out of college doing BCom in financial markets, bachelors in BBI, insurance and other places, when they are coming out, passing out of their degree, there is no subject called personal finance. MBAs coming out of finance know almost nothing of personal finance. I have been to colleges, I have spoken to people, I have spoken to auditoriums full of 500 people and they are like blank. So clearly personal finance and financial literacy needs to start at a lower level. I was never taught personal finance, but because I was born in a family where my father was a financial products seller, there was no financial planning 40 years ago. But because he was in that business and he always kept on talking about these things and those forms kept on coming home, ye kya hai? What is this? Why is this form different? How much money will this make? That is what created that curiosity inside us to chalo, let's see what is going on. That's how we learned. We never had a mentor. Just now you have advisors, you have SEBI regulated entities who can actually come and advise you. So mutual funds will do their own bit by doing IAPs. At the end of an IAP, 20, 30, 40, 50, 100 emails will be collected and they will start now receiving emailers saying this is a scheme or this is an NFO that is getting launched. To get financial literacy, we need to go to the school level. I'm sure it can't go to the first or second standard, but 5th, 8th, 10th standard, definitely there needs to be a subject called personal finance.
No, thanks. So what essentially we conclude here on this discussion is that, of course, democratizing is the part of the core of the future, but you need handholding, you need financial ideas or advice on how your individual path needs to be, and that will only decide whether they will be able to make wealth or not. So it's equally important, like as the GDP is going to double in next 5-7 years, or the per capita is going to double, money is definitely going to the market and DIY are here to stay. But if advisor rahenge, if the wealth manager is around, I think so this DIY guys will be better handled. So we need some technologies where this DIY also gets some alerts, some ideas, so that they don't go into the pitfall, and actually we really build wealth going forward.
All I can say is I'm sitting here on stage today and talking about this because I DIY'd 40 years ago. So there was no mentorship at that time. A stockbroker used to call up and say, "ये share लूँ क्या? हाँ ये ले लो, अच्छा है, double होएगा 6 साल में." That is what we did.
Absolutely.
That's how we learned.
Navalji, a question, because you said something more about REIT, InvIT, and there is a plethora of products. So now in this world, when we start and the wealth is definitely increasing, per capita is doubling up in next 5-7 years. So how do you see the entire landscape changing? As currently we see everything is equity heavy. 90% equity investors, or whenever they are investing, it's only equity. It stops and starts there. So what do you see about real wealth building in wild diversification and REIT, InvIT, or Gift City, which is a new boy in the town? So how do you see DIY versus this entire process of wealth building with these complex products?
Okay, see, when people do DIY, there is no concept of allocation. जो अच्छा लगा, जो historically अच्छा किया है, वो ले लिया, right? With the hope and prayers that it will do well in the future as well, right? But which rarely happens, right? I mean, asset allocation in today's environment is most critical, right? Because not only of all the products that are available in India, but now you can also expand your investment portfolio to global products, right? You are allowed to remit a certain amount of money every year by RBI for investment purposes or for any other specific purposes. Now, there are lots of products which are available in the global markets which may not be available in India, right? So you have the choice of going and investing into those from an allocation perspective. There is equal importance from a geography diversification, right? I mean, you're seeing all the geopolitical issues which are happening globally, right? So the geography diversification becomes important. Currency diversification is equally important, right? I mean, today you've seen the rupee depreciate against most currencies, right? If you have a portfolio, or at least a part of your portfolio allocated in US dollars or any other currency, to that extent it helps you. It also acts as a natural hedge, right? There may be many other investors who have a need for currency because of certain future requirements that they may have. They may have children who want to go and study overseas, or they want to travel overseas, or for whatever reason they may have a need. So why not start building that portfolio today? I mean, if you go back a year, rupee against the dollar was, let's say, at 90-92 levels. Today it's at 94-95 levels, right? So that's the sort of depreciation that you've seen. If you had invested in a dollar product, you would have actually got that appreciation, right? If you look at equity markets, India over the last year and a half is flat, right? Flat to negative. But you look at markets like US, Taiwan, South Korea, and some of the other emerging and developed markets, they have given phenomenal returns, right? So while your majority of the portfolio can be in rupees in India, because that's where you are based, that's where most of your needs are, but from a diversification perspective, you can look at other products. Different asset classes here, different currencies, different geographies. It's best to allocate because you will never be able to time the market.
Well, since you are in this financial planning and all this, how do you see this asset allocation and geographical allocation or currency allocation? How important is, and how here we differentiate against the DIY world?
Right. So what he rightly said, that in DIY it's like whatever worked or it's giving high returns, that will be in the portfolio. So most of them are just chasing returns. So you've been asking that what is a way to build wealth. What I've learned in 2.5 decades is that 3 things build wealth. One is saving consistently. I saved X amount. Can I increase it by, little 10% more the next year, 10% more? So I keep on consistently increasing my savings. Then I earn a consistent return. And I'm not talking about supernormal returns. That's where the investors get it right. Okay, now this is working, let's jump into this. Now that is working, let's jump into that. So they are just chasing supernormal returns. Instead of that, they need to focus on consistent returns. So the return has to be consistent. And then the third thing, which builds wealth, is the power of compounding. When these 3 things come together, consistently increasing savings, a consistent return on that savings and letting that power of compounding work for you, that builds well in the long run. Now, for these three things to fall in place, the R or that consistent R, how do you get that consistent R? That's where asset allocation comes into play, where you invest in all the four major asset classes. So you do equity, you do some bit of it in debt, something in gold and silver, something in real estate. Because if you see historically in the last 3 decades, a diversified portfolio with investments in all assets actually gives more return than just being equity heavy. Okay, now how do people make such decisions, that how do I know how much money to put in gold or how much money to put in equity or debt? So then in that case, you understand your financial goals. Okay, certain goals require just collecting money or saving, because these goals are near term, 3 or 5 years. Then you get into something like a debt. But certain goals are long term, like I have a son who will have higher education in future. So that's a long term goal where my goal is to beat inflation in the long run, and like he rightly said, that he may end up traveling or studying abroad. So apart from being a long term goal, I also have to look at currency as one of the options. So the asset allocation starts with having clarity on the financial goals and the time to the financial goal and the risk taking ability, which will come with understanding your income, expenses, cash flow, other things. Okay, so I think when they have this clarity that what is my financial goal, what is the time to the goal, and then they can bucket it, this is capital appreciation, where I need to beat inflation, and so I need to be in growth assets like equity, real estate. Maybe say my goal is just something which is within 5 years, and I'm not looking at capital appreciation but capital preservation. That's where I will get into debt and some moderate goals, like I would want my child to get married, I would require to give jewelry as a culture. Okay, then in that case I also start building some investments in precious metals. Okay, so I feel when people understand their financial goals, the time to the goal, and their risk taking ability, they can make better asset allocation decisions. And if they understand the only formula to create wealth is save more, consistently earn an R, and let the power of compounding work, I think that's where they would have solved this whole puzzle, and they can still be DIY with this knowledge. What an advisor would have otherwise, helped you stay focused.
Can I add could I
yeah,
add something
please.
to this, what she said? Especially the last part, save consistently, let compounding work. And there's 5 of us here on the stage, and there's only one woman here. And there should come a time where all of us get equal representation. And why am I saying that? Grandmothers, mothers, our wives, sisters are much better investors than this side of the planet. Why? Come what may, during Akshaya Tritiya or Diwali or any festival occasion, they will go and buy that gold coin or that small gold investment for the last 30, 40, 50 years, and they've never sold it. So regular saving has happened, it is consistent, and we all know how compounding has worked in gold. Now, whenever you commented upon being equity heavy, and I always used to tell my wife, why are you putting money in gold? You are getting 8, 9, 10, 12% return. Come this side, come, let's put that same money in mutual funds. We were planning for my daughter's future investment. If I invest in mutual funds, I will get a statement of account. If I am going to a party, will I wear a statement of account? I will wear my gold. I said, no, but that is giving you 10, 12, here it's 15, 16, 18. And for the last 6 months, I haven't been able to look at her face because gold has outperformed all equity investments on 1, 3, 5, 10, and even 15-year basis.
So you one of the biggest 361 into wealth management and HNI and ultra HNI. So how do you get into this a proper diversification? And any one or two strategies which you feel that this is long term and one should resort to this kind of. You must be having some key ideas which you share with your clients. One or two.
For us, the family offices are one larger base of client, right? And one thing that set family offices apart from, I would say, retail investors is how do they think about the money, right? Retail investors think about everything together. Family offices does not do that. They have a capital allocation towards a goal. I'll give you an example. Let's say a family has to serve or give dividends to 20 members for their lifestyle, right? That's their one goal. and they have to sustain, they have to beat inflation just to meet their lifestyle. So they'll think in that fashion, right? If they see, okay, geopolitically situations are not good, probably, right? Or some product which, as Naval said, is not available in India. Last in our panel, we were discussing about crypto, right? If they believe that they have to give an asset a percentage of allocation, they'll think about that, right? Retail investors, because the capital or the corpus that they have is not enough, it's really small, they can't think beyond that, right? So I would say it depends on you, where you are, what is your goal. The most important question that none of us generally ask, even before asset allocation, is why I am doing this, right? If we just start asking that question to ourselves, why this money, I am doing this, I think you will be able to find a better answer to the final asset allocation or what actually works for you.
Absolutely. So I think so. We'll ask for a closing comment, but before that, what I gather from here is that there are two things. One is that handholding is definitely going to play a bigger role. So wealth management firms or wealth managers or guidance is going to be there if we want to have actually democratize wealth rather than democratize transaction. So what today we are doing is a step one, that we are democratizing transactions. But at some point of time, we'll have to work on creating wealth. And wealth with that complexity which is coming, like geography, currency, assets, REIT, InvIT, there is definitely a require of a person who can help you and stop you something. And one more thing I gathered from her is that smart versus discipline. So what I feel is smart people generally tend to wait for the right time, but disciplined people still continues that cycle and maybe top up as a smart person. So I feel that yes, democratizing here to stay, but with a top up of the guidance will work wonder for creating wealth for a lot of people across India. So any closing comment, Nisar, you want to leave behind for the audience?
I just want to probably say that we all study a compound interest formula. We focus on R and not on T. Please understand and focus on T.
Absolutely. That's a very wonderful point.
First of all, a standard SEBI disclaimer that this is not financial advice. Please consult your financial advisor before taking any investment decision. However, if you have the money and if you are not investing now or currently, for the future you are making a big mistake. If you are an SIP investor, if you have money lying in cash, this is the moment you should be dancing. This is all what we were praying for 1.5 years ago when the index touched 86,000. Today we are at 76,000. Buy.
Okay, we've spoken about a lot of things. All I would want to say is that there is no one size which fits all, right? I mean, each individual is unique. They have their own set of requirements, right? If it were a situation where one size or one solution could fit everybody, then DIY would work wonders, right? We could just copy paste and everybody would have made money, right? So it's very, very important that people should learn, understand, get into the details and the nitty-gritties of whatever they're doing, right? It's very, very important to understand what you're doing, why you're doing. I mean, today, if there's a person who wants to go on a 1-week holiday or a 10-week holiday, he'll spend days and months researching about the place where he's going to, where will he go, how will he go, what will he see, what will he eat, how will he go around. I mean, they spend so much time and effort on that. But when it comes to investing, chalo ye le lo, right? No thought, no research, nothing at all. Right, so if you're putting so much time and effort over there, why not for something which is going to help you in the future? Right, so it's very, very important that if you're getting into something, get into it with your eyes, ears all open.
I would say that people really underestimate the power of financial planning, okay, and they jump into investing. Okay, a step before actually beginning your investing is getting a financial plan done. So I would advise most of the people, it can save you a lot of costly mistakes. And apart from mistake, like he said, the time which people forget. You will definitely lose money, but also the time. And both are pretty important in your investing journey. So I would say that do understand the relevance of financial planning. And I'd say that once in a lifetime, a person should make a financial plan because it really changes his perspective about money, about life, about relationships. It's not just hardcore numbers. but money impacts every aspect of our life, all the decisions which we make. And financial plan has that power which can really change things for a person. And so they should keep this in mind and actually start their investing journey with a robust financial plan.
Thanks. I think so. There was a lot of learning here for all of us, and good key takeaways also we have taken. Why democratizing is important, but why a wealth manager is involved, how diversification is important. So thanks everyone for joining this session of BFSI Bharat FinTech, and hope to see you soon. Thank you.
Thank you so much.